Good evening, everyone, and welcome to our first webinar of the year. My name is Gareth Stobie, and I'm joined by my colleagues Mike Brown, Susan Ramutshabi, and Narina Fissa. And tonight we've got a wonderful lineup and agenda planned for you. We're going to take you through investment markets and a look ahead to 2025. It feels like we're already a long way in. Mike's going to be doing the talking in that space. Then moving on to Susan, who's going to give you some key updates on our RA fund and our TFSA capabilities ahead of the tax year end. And then lastly, Narina, who's going to introduce an innovative new portfolio that we have launched. From my side, we're coming off the back of a strong year in investment markets. The South African market was over 13% last year, and US markets were very, very strong. The S&P 500 over 25% actually for last year, whilst other markets and asset classes lagged somewhat. So I'm very interested to hear from my colleague Mike on how he sees the markets and economic outlook going forward. So without any ado, I will pass on to Mike. Thanks, Mike.
Thanks, Gareth. And welcome to all our clients, our friends, and our people who use eTFSA as their investment advisors and their investment platforms. What are the key factors likely to affect financial markets and investor sentiment in 2025? So I'll go through a summary really of our thinking in terms of where we should be going as investors and giving you our opinions, and we'd like to have your feedback at the end of the seminar. So what happened last year? 2024 was the final year of economic adjustment. So if we cast our minds back in 2022, we had this big shock, and we know that what causes recessions, what causes markets to drop, are unexpected shocks, and that shock was Russia invading Ukraine. Inflation went from zero virtually everywhere in the world, or very low inflation rates, up to 9% in the US and even higher in some cases. And we had trade disruptions, we had supply disruptions. That was a massive shock, and so there was an economic adjustment to that shock. The big factor was that monetary policy tightened up drastically. So we went from a 25 basis points interest rate in America, the Fed funds rate, to 5.5%. That was a really big increase, bigger than we've seen for many decades. And then the Fed funds rate stayed flat for a year, and then now it started falling. So that big economic adjustment, and it took place in other areas as well, in terms of trying to slow economies and trying to get rid of this inflation that nobody was expecting. Nobody was expecting those sort of shocks. We would have expected that would have caused us. Susan, you're going to have to use this, make this machine work. Oh, there we go. Thank you. We would expect it to have a recession. You have a big adjustment. It's expected to slow economies. Now, you see from that graph that 2022, just around the period of the Ukraine war, this is the US economy, there was very little growth. But since then, the US economy has grown particularly well. And this year, it looks as though it's going to be more than 3% real GDP growth. So that adjustment took place without massively affecting economic activity worldwide. And we had a lot of economists debating we were going to have hard landings, we were going to have crashes, we were going to have all the rest. All we really had was a soft landing. And that soft landing has already happened. So if people say, well, we think there might still be a recession lurking ahead or a soft landing lurking ahead, that would be very unlikely, because we've already seen this adjustment that's taken place in economic policy, and the US economy and other economies have come through quite well. So what was the other thing that happened, Susan? The next slide. In 2024. Well, we had general elections everywhere. Now, that's one of those issues that, every now and then we have elections. Of course, if we were all smart, we wouldn't elect any politicians, and we can just get along with things very happily without having to have politicians. But what happened last year was that we had a big swing towards right-wing populists or pragmatists. And I'll name a couple of people there. Mr. Milei, Javier Milei, Argentina. He's called the chainsaw because the way he's just cutting expenditure and the way he's changing the way Argentina operates. Giorgia Meloni, well, she was elected as Prime Minister in Italy in 2022, but it's almost a record to have a 2-year term as a Prime Minister of Italy, but she's still there and she's quite right-wing. Japan, we had a very conservative man came into Japan. And of course, right at the end of the year, we had Donald Trump. Now, this is a completely different milieu of politician to what we were experiencing for the previous period with Joe Biden and others. Still to come in 2025, some people say elections are done, they're over. They're not. We've got Marine Le Pen in France, very likely to come in and she's very right-wing. Germany, it looks like a right-wing coalition will be elected in the next month or two. Interesting that Elon Musk was there pushing the right-wing coalition in Germany only a week or two ago. He also pushes Nigel Farage, who's the Reform Party in the UK, and there's a strong possibility that he may have a lot more to do with economic power and political power in the UK. And Justin Trudeau is now resigned in Canada. He's very liberal, and it looks as though the Conservatives will get in. So we've had this right-wing swing globally, and that's something we haven't really seen as on such a universal basis for a number of years. So let's now look at Trumponomics, because that's really what they're all doing, these right-wingers. You can call it Trumponomics, Trumpography, whatever you like to call it, but it's going to be somewhat different to what we've had in the past. Now, what Trump says, he wants to make America great again. Well, America at the moment is pretty great. It's doing very well. It's the strongest economy in the world. So he's not going to upset that too much. He's not going to put anything in place that's going to drive the US into recession or create a fall in the sort of strong standard of living that Americans have got. What's the biggest thing he's doing, or that he wants to do? He wants to roll back the size of government. And that's Elon Musk's job, to set up a new ministry that's going to make American government smaller. And what is Mr. Leo doing in Argentina? He's making government smaller. What's Giorgia Meloni doing in Italy? She's making government smaller. So we've got a rollback in the size of the government. If you can cut government expenditure in America, then of course you can pay for another round of tax cuts. And that's what drove Trump's first administration 4 years ago, was that he cut taxes substantially in America. He wants to do it again, but he wants to make room for that. So getting smaller governments, big factor. Rejection of climate control, very big issue. I mean, the first thing Trump did when he came in, he said, well, I don't believe in climate control, and we're just going to withdraw from the Paris talks. And that really has meant that things like electric vehicles, that could be on the way out. He said, listen, I don't want to stand in the way of American industry by penalizing them, by forcing them to put in measures to control climate. I don't think that can work through the sort of economic measures that we're doing. He's also cooling support substantially, and this has happened even before Trump, for things like inclusion and diversity, for ESG, which is your environmental, social, governance factors. To a large extent, rolling back the wokeness that we've seen in America. Drill, baby, drill. He's saying, listen, I want to go and drill for oil. Let's get as much oil as we need. Let's make America completely self-sufficient, and let's look for resources around the world that we can tap in order to make America self-sufficient. Artificial intelligence, a $500 billion fund to promote artificial intelligence. We saw all these AI technocrats sitting at the presidential inauguration. Bezos, Musk, and others. And that support for AI is a big factor. America's ahead in artificial intelligence and ahead at the moment in terms of technology. He wants to keep that going. And stemming immigration, well, that's a big issue that I think affects all the right-wing politicians. So it's a very different world to the world we've had in the previous 4 years, and perhaps even earlier than that. We've got to now try and learn to live, and this is quite difficult for a lot of us because I'm very liberal. I don't like this sort of right-wing swing, but that's the way the world's going. Tariff protection, he's going to use that as a political weapon, and we've seen that happening already. So let's look at the next slide. What does this mean for financial markets? Well, the place to be for the last number of years has been American market. The S&P 500 is the red line there, and we're taking it back. We're indexing it against the world MSCI index. A lot of people say, well, if I'm going to buy an index, let me just buy a world index, not a specific American index. You've been massively penalized by not being in the American economy and being invested in America in the last, particularly since 2009, since the recovery from the last recession. And I think that's going to continue. What else are we going to see driving markets in the coming year? Susan, the next slide. Well, corporate profits is a big, big factor in America. That just measures the profitability of the companies in the Standard & Poor's 500 index. And that's quarterly numbers. So in the third quarter of 2024, those companies made $3.12 trillion US profits in one quarter. Now, $3.12 trillion is bigger than the South African economy. And this is just private companies in America. There's no evidence that those profits are going to be falling in the fourth quarter. We're starting to see some of the earnings numbers coming through. As long as earnings growth is strong, that means that stock markets will tend to stay firm, and they'll tend to stay strong, because what drives stock markets is earnings. What drives stock markets is the ability to pay dividends. And what drives stock markets is the ability of companies to continue to expand and to have enough working capital and capital expenditure to keep on growing. So those are very strong factors, I think, driving global markets. So what do we favor when we're looking at the global markets? Well, your winning bet, your winning investment has been the S&P for the last quite a few years. We don't think it's time to move away from the S&P 500, but we do think that you could perhaps start looking at a broadening of the Standard & Poor's. So what we do like is the Standard & Poor's 400, which is the mid-cap index in America. So it's not just the big companies, but we think some of those smaller companies, or the mid-cap index in America is very large companies in South African context. But these are all ways of expanding on the S&P 500. Artificial intelligence, tech. It's not going to go away. Some people say, well, those high-tech companies are making so much money. Can that continue? We think it will. And if you don't buy the artificial intelligence through the S&P 500, which is about 1/3 of the S&P 500 is high-tech companies, you can look at the NASDAQ 100 index, which is about 50% high-tech, or the S&P Infotech, which is 100% high-tech, or just buy a FANGS index. All of those are available on the South African market to investors. So that's still the best part of the market, we believe, going forward. Now, we'll give you some warning signals later, because the US markets are quite expensive. What about outside the US? It's been quite critical in 2024 that outside of the American economy, the other economies didn't do nearly as well. The economic adjustment process was a lot poorer for them in terms of economic growth and in the driving of their markets by companies making super profits, which has been the issue in America. The one country that looks quite interesting is Japan. Now, we all gave up on Japan some years ago, but Japan, in fact, at the moment, looks quite interesting. It's actually growing. They're pushing up interest rates rather than falling, interest rates dropping. In Japan, they're actually raising interest rates. But to a minimal extent, they put the interest rate up to 50 basis points, 0.50% last week. They're saying it may go as high as 0.75 by the middle of the year. But they are starting to raise interest rates in Japan because the economy is strong enough to sustain higher interest rates. That's one factor we've got to look at going forward, is that interest rates globally, including in America, Federal Reserve now sitting with a Fed funds rate of 4.5%, is saying, we think interest rates may fall another 50 basis points in 2025. And even if that means a 4% Fed funds rate, we think that interest rate is a sustainable interest rate, and we think that enables us to control monetary policy better than we've had in the past. So we're going to see somewhat higher interest rates. The fact that the US economy could grow 3% last year with a Fed funds rate of well over 5.5% means that they believe that those higher interest rates will sustain lower inflation and more long-term sustainable growth going forward. So Japan could be worth a look. If you buy the world index, 5% of the world index is Japan. So you've got to look at whether you want to have more than that in Japan. What looks quite attractive is if interest rates are going to stay higher, that then means that some equities will have to pay high earnings or dividends to sustain interest relative to what you can get by buying bonds and buying debt. And so high dividend paying ETFs look interesting. Global listed property, somewhat depressed, looks very interesting now that interest rates are coming down a bit. And of course, property companies are very geared to higher and lower interest rates. And public infrastructure looks very attractive because the private sector in this new Trumpology is going to have to pick up as government gets smaller. Who's going to fund infrastructure? It's going to be the private sector. So private credit, bank credit, private raising of funds, I think will become a very important feature of things going forward. Precious metals could be interesting. Last year gold was nice. We didn't really call gold, it happened. And we always gold bulls before last year, but we still think gold looks interesting. And if economic policies in America are going to perhaps be moving against EVs, electric vehicles, well then platinum group metals could become more interesting again as one still needs to meet emission controls, and you do that by using platinum catalysts. To be avoided, UK, Germany, all those other economies. In the UK, it's had no growth for now the last 6 months. They're now talking about the Reeves recession. Rachel Reeves, the Minister of Finance there, causing another recession. We can't blame her, they're already in a recession, but it looks like she's not going to be able to pull them out of recession very quickly. China, everybody keeps waiting for China to come right. They're still battling to come up with a consumer-driven market and to have favorable policies that drive markets and that drive economies and drive confidence. And China could be adversely affected by Trumponomics, not only tariffs, but they're the biggest maker of electric vehicles in the world, and if people stop buying those, they could be in trouble. So that's a bit of a background on the global. Let's just move very quickly into South Africa. Our economy has been quite poor. The third quarter, we had a negative growth rate, very small, but negative. Mainly they're saying that's because of agriculture. Looks like we'll do a little bit better in the fourth quarter. But our economy, the numbers aren't great, but what is looking good is retail sales. They went up at an annualized rate of 7.7% in November, year on year. There were a couple of factors helping that. There was the two pots money coming through into the economy. There was Black Friday. There was Gareth Stobie spending his annual bonus and so on. So there were some special factors, but the retail sales numbers are surprisingly strong in South Africa, and 60% of our economy, 65% is driven by retail sales. What else looks positive in South Africa? The next slide. It took us quite a while to get inflation down. We went up to 9% in 2023, but we're now down to inflation rates of around 3%. And if you look at the month-on-month numbers for the last couple of months, inflation does seem to be much more under control in South Africa. Now, we had the Reserve Bank governor this afternoon. He did drop interest rates by 25 basis points to 7.5%. That's still a very high interest rate. If the inflation rate's only 2 or 3%, why should we have such high interest rates in South Africa? I think interest rates are far too high in South Africa, but that's the way it is. But inflation does give us some scope to perhaps help with some monetary accommodation. And of course, it means that we're no longer having our pockets eroded by high inflation prices. Food inflation year on year at the moment, it's only running at 2.5%. Let's see the next slide. So in South Africa, what I think is increasingly becoming important is what structural factors are driving the economy. Can things get better? The government and national unity, political infighting, it's all politics. It's going to remain like that, I think, up until the municipal elections in 2026. What will very possibly happen is that the DA and the other parties will pull out of the GNU around the municipal elections. The ANC is going to have to fight that on its own. It isn't delivering services in municipalities. It could get a real clop in those elections, and then we'll have to reset what will be the coalitions beyond the 2026 municipal elections. But until then, the politics is going to stay messy, and you're going to get people like Sim Shabalala saying to government, just get out of it, get out of the way, let the economy, let us run the economy in the private sector. Eskom, no load shedding for 300 days. Well, that's been a miracle. It seems as though it's sustainable. all the economists were saying that Eskom's load shedding and so on was knocking 1.5% off economic growth. Now it's no longer happening. They're not adding 1.5% back to South African economic growth, but I think that will happen. We'll start seeing some benefits from that, so that you can now run your factories without load shedding. Transnet's going to get the Eskom treatment. Treasury will guarantee some of their debt, but the money to get Transnet on their feet will have to come from the private sector, and that's happening. We're seeing a number of private sector initiatives to take over road, rail, and so on, infrastructure. Economic reforms progressing steadily. Business sentiment is improving strongly at the moment. And public sector intervention, the private sector coming into the economy, is now well established in South Africa. And I think that will drive us forward. What about our outlook in the market? The big thing to remember is South Africa's stock market is relatively cheap. The price earnings ratio in America is 30 times earnings. In South Africa, it's 14 times earnings. That number is starting to come down as South Africans' earnings growth in companies is not being offset by rising prices in the stock market. So the South African market looks relatively cheap, and I believe that you have to have some exposure to South Africa in your investment strategy. So we can perhaps just finish on our views on where we think you should be for South Africa. Now, some of you will remember that, sorry, back another one, that we had virtually no South African exposure about 2 years ago. Now we're running 30-odd% exposure to South Africa. We still like the big top 40, top 50 companies. We think, though, that there is growing profits being made by mid-cap companies, and we see some very successful mid-cap companies starting to really produce good earnings. So we think you can move, when you look in SA Inc., buy the top 40 or top 50, but also buy the mid-cap index. If you'd bought financials and listed property a year or so ago, 18 months ago, you'd be really laughing. Now, we've done that for most of you. We've positioned most of your portfolios that we run into those sectors. What looks good going forward? Well, you can stay with financials and listed property, but resources are starting to look quite interesting because the resource companies are so cheap, and we're starting to see the log jams, Eskom log jam, Transnet log jam, starting to get better. A lot of people may not realize that the resources 10 index has gone up 13% since the beginning of this year, just in 3 weeks. You may be happy to know that we actually started buying resources for you in our RA funds and all the rest, so we were a little bit anticipatory there. Alternatives, I think income AM ETFs are going to be very interesting going forward because there's more and more products that can give you higher interest rates than money market funds, and that can give you similar interest rates, yields to fixed bonds. And alternatives, gold, PGMs, maybe that's also worth looking at. So there are some alternatives in South Africa, and we believe that whilst we still favor global markets, they are expensive, and don't lose track of the opportunities that are available in the SA market. Thanks for that, Gareth. Let's get Susan to talk specifically about.
Thanks, Mike. And before we do that, just a reminder to all of the listeners that we are taking questions later on. I see a few coming through already. And thanks to Mike for that. Lots of nuggets to pick up on later. Yeah, Susan's going to now take us through key things you need to think about ahead of the tax year end that's just a month away. Thanks, Susan.
Thanks, Gareth. Thanks, Mike. Good evening, ladies and gentlemen. Thank you for joining us this evening, as I'm about to take you guys through saving on your tax and maximizing your investments using your retirement funds and tax-free investments. So before we go any further, I would like to highlight the importance of retirement savings. Why should we save for retirement? Because it seems with research that we're living longer than what we can actually anticipate or save towards, considering that nobody actually knows how long they're going to work or how long they'll be employable. So those are the kind of factors that we should take into consideration. Also remembering that with that, the more you plan and save for retirement, the less dependent you are on your family, on the state, which also will affect and decrease the taxes that we're being charged, that we're all feeling right now. So with that, the sooner you actually start, the better. Why are we saying that? The sooner you start, the quicker you can actually benefit from the effect of compounding. You'll see from the graph here that When you start earlier with that red line, you have longer, and the growth in your portfolio with the effect of compounding will be way better compared to the person who's starting at 45 years, who will only be invested for a shorter period, which means the time for the effect of compounding to effect to longer is actually cut short. And with that, nothing is ever too small. So retirement funds have been made available as little as 300 a month. On our specific retirement fund, you can start with as little as 300 a month with an initial lump sum of 5,000 and 1,000 thereafter. Now we go into simple retirement info. What is a retirement fund for those that are new or are joining us tonight? A retirement fund is retirement savings in your name. So you have the power, the control to make decisions as compared to what we used to have in traditional retirement funds. So you can decide what contribution amount you want to start with, or even once you started, amend or increase or top up, however you want to structure your RA. Secondly, you have a choice of when you want to retire, as long as by regulation it's after you're 55 years. Then lastly, you are safe. It is not some sort of quick scheme. It's protected by law. The portfolios are Regulation 28 compliant. But there's nothing I can highlight more than the benefits of a retirement fund. All returns in a retirement fund are tax exempt. What does this mean for somebody who doesn't know anything about retirement? It means that whatever you're making in your retirement fund is not taxed. So why would you not have an RA? Then let's look at another advantage. All your tax contributions are tax deductible. Another one. What is tax deductible, Susan? It means that whatever contributions you're making to your RA, you're actually not going to pay tax from. So if you have an income, those contributions you're making will be deducted from your taxable income. Another one, why don't you have an RA? Then we go to a very interesting tool in estate planning. Your RA doesn't fall part of your estate, which is a great advantage because we are able to give your beneficiaries access to liquidity or cash quicker than what winding up an estate would do. And most of all, it is such an efficient way to pass generational wealth. So it is something that, if you're considering, should be one of the important parts to consider. Then lastly, retirement funds used to be rigid and people were very dissatisfied, or maybe investors didn't feel comfortable having a retirement fund as compared to savings. Why? Because you couldn't access it in times of emergency or when you have a big event, tragic event happening in your life. Now you can. There's a two-part system where it allows you to do a once-off withdrawal per tax year, but from your own savings pot. So whatever one-third contributions you're making, you can access that once a year, but subject to tax, obviously. But that will go into the kinds of taxes because I know the questions are buzzing. We have, before the two-part system, we had two tax tables, which was the withdrawal tax table and the retirement tax table. Now we have three, being that, not we have, but considering in the retirement industry, we now have three. Because when you withdraw from your savings component, we now will be taxing you from the income tax table, meaning that if you currently are taxed at 36%, whatever you withdraw from your savings component will be taxed at 36%. And for those who are considering to immigrate in future or are planning to withdraw from your preservation funds, we'll be taxing you from the withdrawal tax table. Then we have the very interesting table, which I would encourage most of you to wait till you withdraw, because this retirement table then shows you that at retirement, you have 550,000 tax-free that you can take when you retire. So this is one of the things you can look forward to when you're planning your retirement, that even if you get tempted, consider waiting for retirement. Then we go into why ETFSA. Because ETFSA is a unique retirement fund that is made up of investment portfolios with specifically just ETFs. We have 6 investment portfolios that you can choose from. We are a low-cost structure of just 1% per annum. With that, you can invest your 27.5% contributions into our RA. Obviously, this is capped at 350 per tax year. And with all of that, guys, we are friendly, we're ready to help you at whatever life stage. We have financial planners, we have advisors ready to look into your financial situation, help you see what works for you. And most of all, we're not here to offer you just open an RA and it ends there. We're here for the long term. We're here to take you through the steps, sometimes even with financial planners and advisors, even take you through other sectors of your financial planning, estate, we're here business focused, whatever you actually need assistance with. And most importantly, we are governed by the Pension Funds Act and an independent board of trustees. Then we look at the investment portfolios that we offer on the RA that you can actually choose from or be guided or recommended through. So with that, there's 6 investment portfolios that range from low risk to high risk. We have the Wealth Protector, which is mainly a money market portfolio. The Wealth Conservator being our low risk portfolio. This is mainly for people who are close to retirement and are looking to scale down the risk. Then we have the Wealth Builder, which is our medium risk portfolio. Then the Wealth Default and Wealth Enhancer are our 2 high risk portfolios. While the default gives you sort of a diversified structure, the Wealth Enhancer is a high equity portfolio. Then lastly, we have our Wealth Velocity portfolio, which is new. Yes, it's new, but I'm not going to go into that. I'll leave that for Nerina. Then lastly, we're going to look at the tax-free investment accounts. So the tax-free investments accounts are a very dynamic tool that South Africa has offered to investors, which I would encourage that everybody, the little that you have, consider to invest in your tax-free. Why? Because you can invest as little as the maximum of 36,000 per year, capped at 500,000 per lifetime, and everything you make in a tax-free investment is tax-free. This is your dividends, this is your interest, your capital gains, all of it is tax-free. And with that, it doesn't limit you. You can invest in anything as long as it is collective investment scheme compliant. So you can choose ETFs, you can make up a portfolio, you can take one of our portfolios you'll see in the next slide. Then on our ETFSA platform, the Investor Hub, we offer you the access to actually open your tax-free. We have very helpful ladies that can help you through the process. If you may be someone who's a bit technologically challenged, we're here for you. You can start with as little as 300 a month. We can help you open accounts for minors, even for other third parties. Then we go into the investment portfolios that we offer. With the million of ETFs that are registered on the JSE, we thought, why not create portfolios that can help you not even confuse yourself looking into ETFs? As much as you can, we've made up these portfolios. That's it. Obviously from there, you can see we have the income portfolio, which is mostly property and bonds income. So with the dividend, you'd consider most ETFs that are property, bonds, cash, and so forth. And then we have the international portfolio, which is mostly global. And then the equity portfolio is our portfolio that is structured amongst local and global ETFs. Then lastly, we have our balanced portfolio that gives you access to our balanced portfolio. If you've never heard about our ETFSA Balanced Foundation ETF, this is the way you can actually access that. How do you invest in these portfolios? You can start with as little as 1,000 a month. But over and above the fee of 0.5, we charge a portfolio management fee of 0.25%. 0.25. I think I've taken up all the time that I need to take up. Now it's up to Nerina to give us our new investment portfolio called the Velocity.
Thank you so much, Susan, and a warm welcome from my side as well to all of our clients and listeners online. So, you know, when I was listening to Susan talking about the retirement annuity fund in particular, I asked myself the question again, why do South Africans in general, or many, and certainly people that have been around longer, why do we dislike RA so much? So I thought it may be worthwhile just to go and check what are some of the biggest reasons that people tell us why do they not want to invest in an RA. And probably one of the first things that people will say to you, but my money's stuck until I'm 55 years old. That's just too long. Even though Susan has shared with us how our longevity, our likelihood to live much longer will be way beyond 55. The second reason is fees. And I can tell you to this day, we still see retirement annuities from some providers in South Africa with fee structures of 3, 4, even 5% per annum. That's a killer in terms of the cost of a retirement annuity. So certainly a valid justification why people might not like RAs. I think the one that most people tend to focus on is Regulation 28, that government limits what you can invest in. People don't generally like to be told what they can and can't do. And so this has been a common sort of dislike for people. And what have we seen certainly over many years? Returns have been generally quite poor. So again, can't blame people for not liking RAs. And I think another very important one has been the inflexibility of contributions. So when you are on a retirement annuity product that not only requires you to make a fixed contribution every single month, it even escalates by inflation, and some of those older generation products might be locked in at quite high inflation rates and adjustments every year. No wonder people don't like RAs. But you know what? That was then. And this is now. So where are we now in terms of RAs in South Africa? Well, let's think about that money being stuck until the age of 55. As Susan shared with us, now that we've got Two-Pot, actually some of your money may be accessible before the age of 55. We don't recommend it. Certainly your tax is going to be onerous, but you do have access to some of your funds. The fees, well, you know what, they have come down a lot, and you can shop around. Susan shared with you our RA fund at 1%, certainly very affordable and will make a significant difference to the returns that you get after your fees. So what about Regulation 28? Well, we're going to go into a bit more detail on the next slide, but Regulation 28 has been relaxed significantly across many facets and aspects of Regulation 28. And so why are returns no longer poor in an RA? Well, because you've got lower costs, it means more of the return actually stays in your pocket. And because we are now allowed to invest a lot more offshore, we're also able to enjoy much better returns in our RAs. As far as the inflexibility is concerned, that really is only relevant to the old insurance companies because you have a contractual obligation. You'll hear the term a premium that I've got to pay. With a modern day retirement annuity fund such as the ETFSA RA fund, lots of flexibility. You contribute as and when you can, much more suitable, I think, to the reality of what the working environment in South Africa is all about. So my message to you really is, don't throw the baby out with the bathwater. Don't look back and think, why did I not like them in the past? Rather look forward and say, you know what, there's a lot of amazing benefits to be had. So let's quickly talk about this Regulation 28. You know, it's a term that, a jargon that we in the industry throw around as if everybody's supposed to know what it's all about. And for many people, this is seen as a constraint. It's something that holds you back. It's something that's really bad for you. Our view is quite different in terms of Regulation 28, and rather it provides you with a safeguard, guardrails that actually protects this really important aspect of your wealth building, which is your retirement investments. So what have we seen in terms of it? I'm sure all of you have heard the term prescribed assets, and this has been used in a very alarmist way in media, creating the sense that government is going to dictate where and how we must invest our money. And I think what's the reality is that prescribed assets is not about what you have to invest in. It's rather what are the maximum allowable investment limits. So our thinking around prescribed assets, and I think the evidence is there that we can think quite differently about it. These also, by the way, have only increased these maximum allowable investment limits. So if anything, we've got more flexibility now under Reg 28. Those offshore investment limits, well, you know what? I'm old enough to remember the days when it was 15%. Over the years, we've seen that increase to 20, to 30, and of course, the most recent one a few years ago, it's now sitting at 45% in terms of how much you can invest offshore. And of course, South African investments, especially on the JSE, already give you a lot of exposure to global markets. So we don't really see this as a limit to your ability to grow your wealth any longer. What about infrastructure? That's another one that came up, and a lot of people saw this as oh, this is where government is going to take my money and throw it into some deep, dark, corrupt Eskom pool. The reality is that this is about creating opportunities for retirement funds to invest in projects that will build South Africa for the benefit of all of us. And it's up to the trustees of each retirement fund to decide what is appropriate for their members. This is not about government telling us what to do. This is about the trustees being allowed to exercise their fiduciary responsibility in terms of it. And then I think the one that I really want to focus on tonight is that for a long time there was this perception that another limit of Reg 28 is that you can only invest 75% of your retirement fund in equities. And that's absolutely true, but there is an additional allowance that says equities plus listed property may be up to a maximum of 90%. Now let's just think about listed property. Well, actually, that forms part of what is considered equity. So effectively, government is with this telling us that you are able to invest more than 75% in broader equity considerations because you can take it up to 90%. And so Susan shared with you this graph in terms of the mix of how we can put portfolios together. But we feel that this opportunity of being able to go to 90% in growth assets with equities and listed property is an opportunity that's really missed by most traditional retirement annuity funds. How can you make the most really of what Reg 28 allows you to do? Well, especially if you have a long-term investment horizon. Susan shared graph with us from starting at 25 or 35, or in fact, even if you're 45, you still have a long-term investment horizon, especially if you're going to get quite old. So what do you need in order to grow it? You need growth assets. You want to maximize the growth assets that you have in your portfolio. And what are growth assets? Well, growth assets are equity and listed property. And here we've seen Reg 28 allows us to have 90% of our portfolio in growth assets. The counterbalance to that is that you want to limit income or defensive assets. What are those? Well, interest-bearing, bonds, cash, the things that many of us might think is quite boring or feel it's quite boring. So that's really what you want to do in terms of the opportunity that Reg 28 allows you. So let's just see to what extent do traditional retirement funds miss this opportunity. Well, what I'm showing you there is the breakdown of the ASISA multi-asset high equity. High equity. This is not even medium or low equity. This is supposed to be the high equity portfolio, and consistent with what Susan shared with us before, growth assets in green, defensive assets or income assets in gray. And what you can see there is that even in the high equity portfolio, the average of other funds out there only has 69% in growth assets, despite the fact that they're allowed to have as much as 90%. The new Wealth Velocity portfolio that we've just recently introduced now makes maximum use of that 90% allowance. And you can significantly see that difference between all the green pies on the right-hand side and a very small slither of grey in terms of defensive assets. And this really maximizes that 90% allowance that we have in terms of growth assets. What benefit does that bring to the table? Well, when we look at the long-term returns of different assets, what I'm showing you there in green is the long-term return since 1929. And I think I'm fairly safe to say that nobody in this room was even around by then, and I suspect most of you were neither. But look at, and these, by the way, are real returns. So this is returns above inflation. You can see those growth assets, SA equity, global equity, sitting in the region of 7% real returns per annum over that period. The red bars show you what the returns were over the last 5 years. And as Mike shared with us, we all know that the global equity market, powered by the US, certainly over the last 5 years, was a significant outperformer. So with this combination of being able to invest a lot more in growth assets and now more in global equities as well, that really gives us the opportunity to lift us out of a relatively benign and poor return environment for retirement annuities. To what extent? Well, let's have a look. What I'm showing you there is what the historic return of the wealth velocity portfolio would have been over the last 5 years. On the left-hand side, the darker red line, those give you the bars in terms of the velocity portfolio. The lighter colors on the right-hand side, that is CISA multi-asset high equity category. And you can see the consistency with which adding more growth assets into the portfolio is able to outperform the more traditional interpretation of Reg 28. But adding more growth assets, specifically equities and property, comes with increased variability. I don't even want to use the word risk. I rather want to say more variability. On the right-hand side there, you can see what is the rolling one-year returns of that. In red, the velocity portfolio. In green, the ASISA multi-asset category. And you can see that over time, that can be quite volatile, can be quite variable. But as we increase our investment horizon, 3-year rolling returns, not only do you see that discrepancy between the traditional RA portfolio and the velocity portfolio starts opening up, but we start seeing much smoother return profiles. And in fact, on a 5-year rolling history, you see the extent to which time really works in your favor, giving you that extra performance and comfortably outperforming inflation over that period. And ultimately, that is what we're looking to achieve with our retirement investments. We want to grow our capital over time so we do have sufficient on which to retire. So really, just in closing, I want to share with you, short-term performance in the velocity portfolio should be expected to be more volatile. Expect it. So stay the course. This is not about a one-year wonder. We are interested in that long-term performance that we're going to be getting from the velocity portfolio. You can combine this portfolio also with any of the others that we have in the ETF SA RA fund. Susan shared with you the range of the 6 different portfolios. And so with our guidance and our help, if you need it, we can help you to identify the most appropriate mix of these portfolios should you want to just add some of this to your current retirement annuity fund. Because as with all other ETF SA RA portfolios, there's no cost to switch between the portfolios. So certainly something worth considering for you. And we believe that the velocity portfolio really provides us the opportunity to lift ourselves out of what many of us might have perceived as something quite boring, quite bad, dislike that RA environment. And yes, we've got the light bulb there taking us to the skies, to infinity and beyond, as Buzz Lightyear would have said. Gareth, thank you very much. Back to you.
Great. Thank you, Nerina, and thanks, Susan and Mike. I think those were all very informative presentations and quite varied as well. Susan, you won in terms of the most questions coming through while you were talking.
Oh,
So congratulations.
I'll share with everybody else.
I think, though, let's deal with it sort of as we went through the presentation. Mike, a couple of questions coming through on inflation, and I suppose this listener feels like we all do. How come our home pockets and our home budget feels like inflation is so much higher than the official inflation rate? What do you think is hidden in those numbers there?
It's a perennial question. You always think your own personal inflation rate's higher than everybody else's. That's because you drink a lot of beer and
There you go.
and eat in expensive restaurants and whatever have you. But it's very scientifically measured across all different population groups, across all different locations and so on. And there is a very definite downward trend in South African inflation. And I don't think we've won the war against inflation, but I think that trend downwards in inflation is very good for financial markets. Equity markets do better, and so do other asset classes in lower inflation environments. So whilst I sympathize with your own personal inflation rate for that particular question, we have to work with the fairly scientific way in which inflation is measured. And if you go to the supermarket on a Saturday morning and there's some bloke there with a machine measuring his mobile phone price, and you say, "What the hell are you doing?" "No, I'm collecting the inflation numbers." They told exactly which products to measure and all the rest. And this is not being written down. This is being sent through mobile connections. So it's quite scientifically measured. But let's take it on the basis that inflation is probably declined fairly substantially. It'll probably stay more or less under control because the Reserve Bank is very wary of of letting interest rates drop too quickly, of letting loose on the economy to allow inflation to increase.
Yeah, and at least we're getting some interest rate relief coming through the reduction again today in local interest rates. Question that's come through, we didn't touch on the world of crypto today. Question around, do we see a crypto ETF coming? Narina, since we've added cryptos actually to our phase license, haven't we? Maybe it's a question that you can touch
Sure.
on and how and if we are using crypto on client accounts.
Yeah, thanks, Gareth. So yes, we've certainly seen significant progress in the South African scene around crypto. And I think the Financial Services Conduct Authority has been very proactive in terms of introducing regulations in a very well-considered way. So ETFSA is a crypto asset service provider. We are licensed and registered with the FSCA to provide both advice to clients, but also offer intermediary services. What does that mean? Well, we don't have a crypto ETF listed on the JSE just yet. It's bound to come. We don't have a timeline on that, but it's bound to come. However, where we do manage portfolios for clients in offshore markets, it's been just over a year now since the first Bitcoin ETFs were listed in the US. So we are able to incorporate crypto ETFs for our clients in the offshore managed portfolios that we do. Not only are we licensed to do so, but we have access to do so as well via those offshore markets.
Yeah. I think we some way off in terms of owning crypto in any of our managed accounts, or certainly within our RA where it's not currently allowed. Yeah. Okay, in terms of the RA, Susan, a very interesting question that caught my eye here is around someone who's saving for their kids. Should they be actually starting an RA for a minor? And you can do that, can't you?
Yes, you can.
Compared to starting a tax-free savings account for that minor. What would be the pros and cons of an RA over a TFSA?
Okay, I think the most important would certainly go back to what your plan is. So if you are actually saving for this child because by the time they get to 18 and they're in varsity, they can access it, then go for it. Take a tax-free investment. But if you're looking at the long term, so this is you wanting to maintain that there is no accessibility, then go for the RA, because you know for sure that this child will have the RA started at very young. They start working, they continue contributing to this, and it's literally like a wealth plan on the long term. So it really depends on what your plan is in that sense.
Yeah, I mean, I think if you look at that compounded chart that we put forward, I mean I can't even think of starting a pension when I'm not working yet. But imagine if you add another 10 years to that, or another 15 years to that, the difference it'll make over an extended period of time. So it's a fascinating question. It does depend on access at the end of the day, whether you want to get access before or not. A few people asking around, how do they transfer from one RA to another? So let's say they're in, I don't know, an RA issued by one of the life insurers, and they want to move into this new Velocity portfolio that Narina was talking about. Take us through some of the process involved with that.
Okay, so the process of transferring from one RA to another is called a Section 14 transfer process. That is a process where we would actually do the transfer on your behalf, but you'd need to sort of go through the process of the application and doing everything. And a lot of people will ask, why are you wanting me to do the application before doing the transfer? We first have to have you as a client, KYC. We cannot do a transfer for you without knowing who you are, what your goals are, and so forth. So we first need to go through the process of loading you in our system. Then I would then do the Section 14 transfer on your behalf. And the time frame for that, regulation allows 6 months, but with most insurers, we can do 2 to 3 months to finalize the transfer.
Interestingly, quite a few people who are beyond the retirement age of 55 asking about RAs or the ability to invest either in a living annuity or an RA. Mike, perhaps it's a question you'd like to tackle around the do's and don'ts there.
You can start a retirement annuity, which is a retirement fund in your own name at any age. So you could be 80 and you could set up a retirement annuity fund. Why would you do that? 2 reasons. One is because you get tax deductions for your contributions. And secondly, if something does happen to you and you don't live till 110, you only live till 93 or something like that, that money sitting in your retirement annuity does not form part of your estate. There's no estate duties. It can be settle very quickly. So your beneficiaries or heirs can or dependents can get access to that money very quickly. So an RA is a tool that you can use at any stage of your life in terms of saving. So don't look at it as only something that's going to generate a retirement fund or for me or a pension fund once I get to retirement. You can also use it as a very tax efficient tool going beyond that.
Okay.
Gareth, may I just add to that maybe, because we talk about time horizon, and I think we sometimes still have this perception that time horizon is about how far am I away from my retirement date. And I think it's quite an outdated concept actually, because there's quite a big difference between retirement as in I'm no longer working actively and earning a salary from that versus retiring out of a retirement fund or retirement annuity. And so because we know that after the age of 55, one can retire at any point in time should you need to do so, as Mike was just explaining in terms of the tax benefits for somebody who's older than 55, making contributions, such a person's time horizon is actually very long term. They might be 80 years old, but their time horizon is really focused on their dependents, on their beneficiaries. So I think we must be careful to think that time horizon is necessarily linked to your age. And that's certainly something that we can help you with to decide what is an appropriate time horizon and therefore almost the risk profile of your retirement fund investments. We can certainly help you with that.
And then coming back to that minor question, starting an RA when you're young. I mean, obviously, if you're a minor, you're not paying tax. But the tax deductibility of RA is just one of the benefits. All of the returns inside of an RA are still tax exempt, the same as they would be in a TFSA. So the 27.5% that we referenced earlier is the maximum contribution. There is no minimum in terms of the tax thing. Just to answer one of the other questions that's come
I
through.
think, Gareth, if we can just add there that our tax-free investment accounts have been now operating for about 11 years or so. So over that period of time, if you'd maximized, I think it started off with 30,000 Rand or even less than that. Now it's 36,000 Rand a year. If you'd put that into a tax-free account for a minor, now we've got a lot of those tax-free accounts are sitting at 600, 650,000 Rand. That's how quickly 36,000 Rand annualized or whatever number can grow. And now you've got direct access to that. So if you want at the age of 18 to start paying your university fees by accessing your tax-free investment account at no tax, there's no capital gains tax, there's no tax penalties at all. I think they're great savings tools. And I think it's been a very good initiative by the government to set that in place. And we've been, actually, it's amazing how well that's been adopted to by the South African public. So that's a great product. A retirement annuity, as Susan said, you've got some benefits of contributions being tax deductible, but you're not a taxpayer until you start working. And then you're locked in until 55. Okay, now you've got the savings component of your RA. But I think the first thing to do, and Nerina and Susan might agree with me, start with a tax-free account for a minor, and then look at an RA as a second option.
Definitely.
Okay. There's a tongue-in-cheek question here from one of our listeners around, wow, no mention of DeepSeek and artificial intelligence. Michael, we're actually not here this evening. We're all sitting at home, and the whole presentation was generated via artificial intelligence. I'm not sure if you noticed that. So there's the DeepSeek reference.
Hey, we focus on HI, human intelligence. Of that, we have a lot.
Quite right. So I think, by and large, a lot of the questions were of a technical nature to do with RAs and the functioning of that. I'd like to assure all the listeners that we will work through this list of questions one by one and get back to everyone, and also that the recording is going to remain available. And we're nearly coming up for 6 o'clock, which is the official end, but I think we can carry on taking questions for a while longer if you guys are up for that. So I'm just going to scan through some of the others here.
There was a glitch in your AI. We're coming up for 7 o'clock, Gareth, and not 6 o'clock.
Oh, sorry.
Time zone.
There you go.
Your DeepSeek is a little bit...
It's the type of error that you'll find in those things, won't you? Someone here with money offshore in hard currency and asking us whether ETFSA runs hard currency portfolios, ETFs. Maybe, Nerina, that's something that you can talk about. We spoke about crypto ETFs being available offshore, what other types of ETF
Yeah.
services do we
Yeah.
provide?
So certainly ETFSA offers the management of portfolios in hard currency, physically held in offshore accounts. And we find that this is a service that is very attractive to clients that already have money in offshore markets. Often you might find that that money is lying somewhere in a bank account, not really earning all that much interest, or it might be in, being managed in quite an expensive way by an offshore fund manager. And we manage those offshore portfolios exactly the same as we manage the portfolios here in South Africa, making use of what is offshore, a much more extensive range of ETFs that we can use, and we then construct individualized, bespoke, custom portfolios for each client that we ensure matches your investment objectives and your investment requirements. And I think also quite importantly that we do so in conjunction with any other assets that you might have. And that's the reason why we customize it so much. I think typically with these sort of offshore wealth management services, you often find that it's you get panel beaten into a predefined product structure, whereas at ETFSA we do so very much on an individualized basis based on what the client needs and objectives are.
And definitely in the Saxo accounts, it's very individualized. However, on the other side of the business, within the hub, which is our direct platform, and maybe Susan to touch on those model portfolios that you put up, I think the one bit of feedback that we've had from clients now that we've got over 200 odd ETFs available in our market is, where do I start? How do I even get going? And so to have those pooled portfolios that focus one on just income or just global equity or local equity or balance is really quite helpful. And we've seen actually a big take up in those portfolios. And when I joined the company about 1.5 years ago, those portfolios were relatively small, and we've seen lots more clients take them up over the last while, which is showing that people are benefiting from that sort of guided architecture. But you're also obviously welcome to phone any of the team at any point just to sanity check any of those decisions. Right, it's now after 7 o'clock. We've got a few thank yous coming through. It's a great pleasure for us to stay on into the evening. For me personally, it meant missing part of the JSK cricket game. So if you sat here instead of watching cricket, then good on you. As I say, the recording is available. If you've got any more questions, give us a shout. But I think let's wrap it up there. Otherwise, we tend to just drag on for the sake of it. And you can be assured that any of your individual questions will be taken. Yeah, so thanks to Mike, Susan and Narina and the rest of our team for all of the effort that's gone into this, and for the people who you can't see behind the scenes here doing the recording and the technical work. So thank you for all of that. All right, good night to everyone. Thank you.
Thank you.